Hi, welcome to our recorded management accounting lectures. For this lecture, what we will be discussing is analysis of variances or flexible budgets and variance analysis. This lecture takes off from the previous week's lecture where you learned how to create budgets, for a company. And out of that budget, what we will now do is to consider the concept of flexible budgets and at the same time analyze performance of a company in relation to the budget that was constructed for the company. We'll explain more as we go through the next slides. First, we discussed the concept of flexible budgets, and this is a very important concept in terms of performance analysis. No, and we are now in the realm of trying to figure out whether a company performed well, better, or worse off versus its intended performance. And its intended performance was captured by the budget that was crafted last week or in last week's lesson. So this week, what we will do is now try to compare performance, actual performance versus that was budgeted. How do we then compare performance properly? A very important concept in terms of comparing performance is the concept of flexible budgets. And that's what we will do in the next few slides. But first, we need to understand the variance analysis cycle. No? In any business, no, in any business, we typically start with the planning process. Okay. And the main output of the planning process is the creation of the budget. Okay. And with the creation of the budget, what happens now is the budget are the quantitative expressions of a company's plans, right? And based on the plan, the next step now is for them to execute those plans, no? And as a company executes plans, no, meron nang magkakaroon na ng actual performance. Okay? And now the variance analysis cycle is to analyze actual performance. How did it compare versus the budget? No, and what kind of uh, operational adjustments need to be done so that they can be at par with budget or even outperform budget. No, so we are now in the phase of performance measurement. So wala na tayo sa planning process. We are now in the process of executing those plans. And once the actual results come in a specific month, for example, we need to analyze that performance so that we know how to take action. No, and that's the essence of the performance. Okay. Um, so it all starts with conducting the period's performance. So for example, we are now, for example, in February. During February, the results of January has already come in. Nag-implement ka na during January and therefore may actual ka na. Actual revenues, actual expenses, actual net income. Okay? The first thing that you need to do is to prepare a performance report. Okay? And in that performance report, we are going to look at the variances. Variances between what? Between actual performance versus plan. Okay, that's the idea, and that's the idea of what we are going to do for this lecture. Okay, so with that, after creating that report, what you need to do is to analyze the variances. What are variances? Variances are difference between actual results and plan or the budget. Okay, and we need to look at those variances, analyze them, raise questions. So what kind of questions? Explaining bakit may variance. so that you can identify the root causes of those variances and for the company to take action, and so that you can conduct next period's operations with better perspective on what you did wrong, what you did correctly in January. So that pagdating ng February, alam mo yung gagawin mo. No? You know how to perform or how to improve operations or to sustain good operations. Okay? So we are looking at this process and we are looking at flexible budgets and variance analysis na nasa kalagitnaan na tayo ng taon. Okay, that we want to keep track of performance and we want to compare them against the budget. Okay, now we need to discuss what are flexible budgets. No? We have to differentiate between what's called static budgets and flexible budgets. Okay, yung planning budgets are prepared for a single planned level of activity. This planning budget is called the technical, or I mean the static budget. Ano ibig sabihin nun? For example, if you're in 2019 and then you are planning the operations for 2020, will be creating a budget for 2020, right? And as we do that, what will you do? You will assume a set of activities for 2020. No? What are those activities? You will assume a certain level of sales, and that's the target of the company with respect to sales. The company will assume some expenses, no? And that's the target of the company with respect to expenses and ultimately net income. Okay, so those are the plans for 2020 as it was conceived in 2019. That plan is the main blueprint of the company for 2020. And that blueprint for the whole 2020 is called the static budget. Yan yung pinlano mo for the whole year of 2020. No? And that is your intended results. Okay? So, pag anong nangyari, nagka-2020 ka na, meron kang static budget, right? Pagdating ng 2020, meron kang actuals. Okay? So, you want to compare actuals versus budget. And in so doing, you're able to explain or see variances or differences between the two. And we want to explain those variances. Okay? But one key characteristic of static budgets is that they are fixed to the planned level of activity. What's the planned level of activity? For example, ang target mong sales for 2020, 200,000 units. Yun yung target mo for 2020. Hindi mababago yun. Right? That will always be your target for 2020. However, there are costs and expenses that move with sales. Right? Some are fixed, some are variable. No? So it may be difficult to explain performance, no, if the actual level of activity differs from the planned level of activity. No? The example is in the next slide, so we'll hold off on the example till the next slides. Okay. So enter flexible budgets. No? Flexible budgets, ang pinagkaiba ng flexible budgets is, no, it is prepared for any activity level in the relevant range. What does that mean? Okay? It means na finiflex mo yung budget in such a way na ano kaya yung naging budget ko for 2020 kung alam ko na ang aking planned output is equal to the actual output in 2020. Okay? So for example, in the 2020 budget, okay, in terms of sales, ang sabi ko, magbebenta tayo ng 1,000 units. Yan ang aking forecast for 2020. However, 2020 actuals, anong nangyari? Halimbawa, 1,500 to overperform. Okay? So, it might be difficult to compare cost of goods sold, for example. Kasi natural, mas mataas ang cost of goods sold ng 1,500 versus 1,000. Right? That's just natural. Why? Because mas marami kang binenta ng 2020 eh. So, dahil 500 more yan, you expect cost of goods sold to be a lot also versus 2020. Okay? Kasi yung 2020, based sa 1,000 units sold. But yung 2021 based sa 1.5 units sold. So cost of goods sold will definitely be higher, okay, than that in the 2020 budget. Okay? So hindi apples to apples sa comparison, hindi mo tuloy malaman efficient ba yung operations ko, no? Kasi namamask siya by the fact that there's a higher activity level for 2020 actuals. Okay? So what we want to do is to flex the budget. Gagawa ka ng 2020 flexible budget in such a way na what would have been my budget if I knew that my sales is equal to 1.5. Okay? Let's recreate the budget. No? Kung alam kong 1.5 ang sales, ano ba dapat yung costs and expenses na i-incur ko? In that way, it allows you to have an apples to apples cost comparison. And it all help managers control cost and improve the evaluation of performance. Let's look at the next slide. Okay, so here is an example. So the company provides lawn care in a planned community. No? At the end of May, no, Larry prepared his June budget based on mowing 500 lawns. So ang budget niya is based on 500 lawns na imo-mow. So therefore, lahat ng expenses niya na variable based on 500 loads. Yung revenue niya based on 500 loads. And that's what we see here. No? If you look at his static budget, what do you see? No? Revenue is 75Q, where Q is 500. Okay? Ang wages niya, variable. Ang gasoline, variable. Pati ang equipment and maintenance, variable also. A function of Q. Okay? The rest are fixed costs. So, knowing that these costs are variable, these costs are fixed, okay, and in my plan, I have 500 number of lawns to mow. The budgeted operating income is $5,000. That's the target for June. Let's look at the actual results in the right side. If you look at the actual results, overperform. Your Q is equal to 550. So you were able to overperform the static budget. No? And if you look at the but the actual operating income, 6,450. 6,450 is definitely higher than 5,000. So good. No? Ang tawag dyan, it is a favorable variance, right? So if you look at net operating income, okay, the actual is 6,450. The planning budget is 5,000. The difference between the two, which is 1,450, is called a favorable variance. It's a deviation from budget, but it's favorable kasi profit accretive. Okay. If you look at wages, it's 20,000 in the budget, 23,500 in actuals. So, mas malaki yung expenses versus the budget. Ang tawag dyan, that's called an unfavorable variance. Why is it an unfavorable variance? It's unfavorable because the actual expenses is higher than what was budgeted. I spent more, right? But if you look at it, actually, it makes sense that it's unfavorable. Why? Because I mowed more. Okay? I mowed 50 more lawns than what was budgeted. Naturally, my expenses will be higher. So I don't know whether 23,500 is necessarily good performance, right? Did I spend more than what I should have spent for 550 lawns? No? That's something that we won't know. Okay? So when we make that analysis or comparison between the static budget and the actuals, no, this is the report, no, that we will see. So if you look at revenues, favorable. How much is the favorable variance? 5. Why is it favorable? Because in terms of revenues, actual is higher than budget. Okay. If you look at wages, it's 3.5 unfavorable. Why is it unfavorable? Actual expenses is greater than planned or budgeted expenses. Okay. So if you look at all of these line items, what does it show? It shows that overall, there's a 1,450 favorable variance to net operating income. What are the key drivers of that? Favorable variance in revenue and some savings in equipment maintenance and office and shop utilities. No? However, however, it was counteracted by unfavorable variances in wages and gasoline. Okay, so that's how you explain the variance in net operating income. No, however, as mentioned, um, the favorable operating income is something that we expect. Why do we expect it? Natural, mas maraming nabenta. So dapat lang mas malaki yung kita. No? But ang tanong, were they really efficient in the way they operated in June? No? We can't know for certain. And how do we then evaluate that? We evaluate that by making a flexible budget. No? So how does a flexible budget works? No? So to do that, no, we must flex or the budget, adjust the static budget so that so that we will equate planned activity to actual activity. What does that mean in terms of our example? In terms of our example, it means you have to recast the budget. Kung alam kong 550 ang mabibenta ko in June, what would have been my budget? No, assuming the same assumptions that I did in my static budget. Okay? How do you do that? You do it this way. Okay? You compare or you create a flexible budget. Remember, ito yung mga naging assumptions mo in creating the budget, right? The only difference now is that you are using 550 instead of 500. Okay? So you recreate the budget. What is the budget if I knew na 550? What would have been the budget if I knew na 550 talaga yung mabibenta? How do you do that? As I mentioned, kung ano yung assumption mo in the static budget, gamitin mo lang yung same assumption, i-plug mo lang yung new volume here sa mga Q. Right? And with that, you can compute for the operating income that you should expect, that you would have expected if you knew, no, that the flexible budget is, if you knew that the number of lawns to be mowed is 550. No? And with that, makikita mo kung efficient ba talaga sila or hindi in the operations. Okay? So, ito, ginawa na yan for you. So, for revenue, 75Q. Siguro 75 yung selling price. No? So, 75 times 50, 41,250. For wages and supplies and salaries, it's fixed cost. 5,000 plus 30Q. So, if you substitute 550 to Q, you will get 21,500. And so on and so forth until you arrive at the total expenses and net operating income. With that, we're able to now compare actual performance in apples to, and the flexible budget based on an apples to apples comparison, which is equal to 550 loans. And what do we see? Okay. With that, anong nakita mo? Ang nakita natin is that actually, hindi efficient yung operations. If you look at it. Okay. Actually, 200 unfavorable siya dapat. Remember, I'll go back several. Yan. Remember, ito siya dati. No? Nung hindi naka-flex yung pag-comparison mo, planning budget or the static budget, ito. No? Ang lumalabas na performance is 1,450 favorable, right? Okay. But if you look at it, what if you look at it in terms of comparable apples to apples analysis, if you knew that 550 was the output, actually it's 200 unfavorable effect to net operating income. Okay. It was not an efficient operation. And what was the cause, main cause of that variance? It's this one, no? Wages and salaries. No? It counteracted the gains that you would have gotten, no, from the additional revenues. And that was the main reason, actually, no, why the ultimate result is 200. Saan galing yung 200 unfavorable? The actual results resulted in 6,450 net operating income. I'm comparing 650 against 6,650. Saan galing 6,650? 6,650 is the flexible budget net income. No, and this is the net income that would have been expected, okay, if we knew during the planning process that uh, the number of loans was really 550, and we should have expected 6,650, but we only got 6,450. So there's inefficiency in the middle lines, in several aspects of performance. Okay, so that's how we are implementing flexible budgets. Okay, now with this comparison between actual results and flexible budgets, you are now introduced to the concept of variances. Okay, variances are the specifically revenue and spending variances, are variances that arise from difference between actual results and the flexible budget. Okay, the difference between the two are the variances. This one is called a revenue variance. Okay, so the revenue variance is 1,750 favorable. Why is it favorable to the company? Actual is greater than budget. Flexible budget for revenues. Okay. These, on the other hand, are called spending variances. Okay. Because they are variances with respect to expenses. So for example, wages and utilities is 2,000 unfavorable. What's the reason behind that? The actual expenses is 23,500 when I expect that at 550 my expenses should have been 21,500 only. So I spent more, so therefore it's unfavorable. No? On the other hand, if you look at office shop and utilities, no? Office shop and utilities is 50 favorable. Why is that? The actual expenses is 950. Under the flexible budget, I expected to shell out 1,000. So therefore, nakasave ako ng 50 and therefore that is less expenses for me. So that's favorable for me. Okay. So with this, we will transition to the concept of variance analysis. Variance analysis talks about um, getting the root causes of these variances. No? Bakit 2,000 unfavorable ang variance sa wages and salaries? No? In any expense, there are usually two components. No? In any expense, there are usually two components, right? No? There's a price component and a quantity component. Okay? Pwedeng mas marami ang ginastos mo kasi mas mahal per unit. Okay? Or mas marami kang ginamit for the same number of units of production. Okay? And this section gives you a framework of explaining this 2,000 variance. Okay? Nanggaling ba yan kasi mahal ang naging sweldo per tao? Or mahal ba yan kasi mas marami akong ginamit na tao versus what I expected. So there's a price variance and there's a quantity variance. And that's what we will do in the next portion. But in doing that, we need to understand what standard costs are. So standard costs are benchmarks or norms for measuring performance. So in managerial accounting, there are two usual standards, quantity standards and price standards. Okay? So yung quantity standards, it specifies how much of an input should be used to make a product or private or provide a service. Let's go directly to the example. The example is, no, for example, ikaw ay nagtitinda ng pizza. The quantity standard is the budgeted amount of flour or cheese or bell pepper that you assumed in the budget to produce one pizza. So it can be 30 grams per pizza. 30 grams is your quantity standard. Okay? For one output of pizza, 30 grams of flour must be used. If you use 32, then you're spending more, right? Because you used more for one pizza, which has the same revenue impact. Okay? The second kind of standard is price standard. Specifies how much should be paid for each unit of the input. So in our example of pizza, you know, you assumed a budget for the amount of grams per flour or peso per gram of flour that's being used. Say 2 pesos per gram used. That is your budget for flour. If that's the case, then that is your price standard. At if bumili ka ng flour na mas mahal sa 2 pesos per gram, ibig sabihin, unfavorable variance din yun because you spent more than what you intended in the budget. Okay? So this is an example of a standard cost card. It is archaic. Actually, manual operations na lang gumagamit ito. Usually, nasa SAP na yan or sa nasa accounting system or standard cost system or ERP system. But I included it still because it illustrates what standards are. Okay, this is the standard cost card, for example, of one product. So, for example, this is pizza. One pizza. Okay, one pizza, for example, uses 3 pounds of a certain direct material. That's the standard quantity or standard quantity per unit or per piece. At ang standard price ng direct materials na yan is 4 pesos per pound. Okay? So therefore, I expect, okay, that for 1 unit of pizza, I will be spending 12 pesos or $12 of direct materials because $4 per pound, I expect to use 3 pounds. So this is the quantity standard. This now is the price standard. And for every unit of pizza, there are various components to the standard cost. Merong direct materials, merong direct labor, meron din namang overhead. Okay? And with that, there are standard quantity standards at meron din namang price standards per unit of pizza. And with that, you're able to get the cost or the standard cost per unit of a pizza. Okay? And with that, we know na kumalaw man yung level of output, okay, we know that this is the standard relationship between one pizza and the amount of direct materials, direct labor, and overhead that I'm going to use at these prices. If there are deviations with that, then meron tayong variances. Okay? Okay, let's go to the next slide. So now what we do is standard costs are the heart of variance analysis. No? So you can compute the standard costs per unit of direct materials, direct labor, and overhead. It can be used to compute activity and spending variances. Okay? So the variance is usually divided into two, or categorized into two. The price variance and the quantity variance. Simply put, the price variance is the increase or decrease in costs as a result of differences between standard prices. So if you look at our example, the standard price is 4 per pound. Kung in actual naging 5 per pound, that's a cost of of a variance. Specifically, that's a price variance. I planned for only $4. In reality, nung bumili na ako sa merkado, it becomes $5 kasi syempre, prices fluctuate. Okay? And with that, um, that is a source of variance. Okay? The second type of variance is quantity variance. You used more than what you intended. No? So there's a positive or favorable or unfavorable variance, no? Because there's a difference in the actual quantity used than what was the standard quantity used. In our previous example, the intention is that for every pizza, 3 pounds of direct materials ang gagamitin. Pero for some reason, mas konti lang yung nagagamit ko and it's able to produce one pizza, right? So that could be a favorable quantity variance, right? Because I used less than what I intended, no, to produce an acceptable output. Okay, so that variance is called the quantity variance. Let's have a generalized model for variance analysis. Okay, in essence, the formula can be broken down this way. Okay, let's look at the specific boxes. Box 1 is actual quantity times actual price. In essence, this is the actuals, no? Actual quantity used and actual price of the inputs that you used. Okay, so in other words, actuals. Okay, here on box number 3, it's standard quantity times standard price. Okay, in other words, this is based on a flexible budget. Okay, the standard quantity allowed for the actual output at standard prices. We'll explain more about the standard quantity allowed for actual output. We'll explain that through the first example. But all you need to understand is this box refers to the actuals. Yung actual na ginastos times per unit times actual na ginamit na quantities. The far side, no, is standard quantity at standard prices. And standard quantity is the amount allowed for actual output according to the relationship in your standard cost cards. Okay? According to this relationship. Okay? Now, ano yung nasa gitna? Yung nasa gitna is actual quantity times standard prices. So, siya na yung nasa gitna. Kinuha na yung actual quantity dito at saka standard prices dito. Okay? Now, the difference between 2 and 1, that's called the price variance. And the difference between 3 and 2, that's called the quantity variance. And the sum of the two is called the spending variance. Actually, the difference between 1 and 3, that is the spending variance. Okay? Let's have an example in terms of direct materials so that I can explain it further. Okay? So Glacier Peak Outfitters has the following direct material standard for the fiber fill in its mountain parka. So it makes parkas. The standard quantity is 0.1 kilograms per parka. And the standard price is $5 per parka. Okay, so let's list it. Let's list it down. Standard quantity is 0.1 per parka. Standard price is $5 per kilogram of fiber fill used. Okay, last month 210 kilograms of fiber fill were purchased and used. So in terms of fiber fill, 210 kilograms were used. So this is the actual quantity used, right? And use 210 kilograms to make 2,000 parkas. Okay, that's the relationship. and the total material costs is 1,029 for all 210 kilograms of fiber fill used. Now let's assemble the table. Actually, it has been assembled, pero we will have to discuss it. Let's do number one. Okay, box one. For box one, it's an actual quantity times actual price. The actual quantity is 210 kilograms. Okay, which is the actual quantity of fiber fill used for last month. Okay, saan ngayon nanggaling yung 490? Okay, 490 came from 1,029 divided by 210 kilograms. Okay, to get the actual price, and that actual price is 490. So 210 times 490, it gives you 1,029, which is equal to the amount actually spent. Okay, so yun yung actual, yung box 1, which is the actual amount spent. Let us fill in box 3, standard quantity times standard price. Okay. Let me erase some of the calculations para may space. Okay. So, if you look at this, saan galing yung 5 per kilogram? No? 5 per kilogram is this one, right? Which is the standard price for every kilo of fiber fill used. So, okay yan, madali yan. The next question is, where did you get 200 kilograms? Wala naman 200 dyan kahit ano. Diyan pumapasok yung concept ng standard quantity allowed for actual output. What is the actual output? The actual output is 2,000 parkas, right? If the quantity standard will hold, gaano dapat karaming fiber fill ang gamitin? Ilang kilo ng fiber fill dapat ang gamitin? Okay? So basically, you will use this relationship, right? Supposed to be, it's 0.1 kilograms of fiber fill per parka. And if there were 2,000 parkas, it means you will be using 2,000 times 0.1 kilograms of fiber fill. And that's how we got 200. Okay? And with that, we can compute, no, that the box 3, which is standard quantity at standard prices, is 1,000. Okay? So actually, the total variance, the total spending variance is what? Actual, yung number 1, box number 1, 1029 versus box number 3, which is the standard or the flexible budget, 1,000. Actually, what we are explaining is 29 unfavorable, right? Because the flexible budget is 1,000. The actuals is 1029. So their difference is 29 unfavorable. What is the source of the 29 unfavorable? That's where the second calculation will enter. Okay? At the second calculation, what do? We use actual quantity, which is 210, at standard prices, which is 5. So with that, we get 1050. And the difference between these two is the price variance. And the difference between these two is called the quantity variance. Okay, so what's now our explanation? Our explanation is the unfavorable $29 result is due to two factors. No? There was a $50 unfavorable variance for quantity, but there was a 21 favorable variance for price. In other words, kaya mas mahal, kaya mas marami akong ginamit, kaya mas marami akong ginastos, no, versus the flexible budget is because I used more quantities. No, I was not efficient in the use of the fiber fills. I used more than what was expected. And that was the reason why there was an unfavorable variance. Why is it important to pinpoint it this way? It's important to pinpoint it this way because you can actually tag, no, different departments of a company with respect to variances. So for example, the quantity variance, no, usually that's the responsibility of the production department. Bakit? Kasi sila yung gumagamit ng material. Right? So if the quantity variance is unfavorable, there are a lot of wastage. No? And therefore, with a lot of wastage, kasalanan yun ng production, right? Magtipid sila sa materials. Okay? Price variance naman, usually it's purchasing that has um, ultimate responsibility over it. Hindi naman yung mga taga-planta yung bumili ng material. Eh. No? Supply chain yun or purchasing, right? And therefore, the purchasing department has to explain why mas mahal yung kanilang materials. No? So that's why that's the value of calculating the variances, no? Because it gives everyone uh, uh, because it allows management to tag performance to specific departments. However, there are also issues on accountability. Hindi naman perfect yung measure na yan. Right? Because for example, the production manager can always say, kaya marami kaming na sayang kasi cheap yung materials, hindi matibay. No? Because purchased cheap materials, so my people had to use more of it. Maraming nasisira, gutay-gutay, for example. So, I can blame still the purchasing department. Purchasing naman will say, kasi kayo, rush kayo palagi maghingi ng materyales. So therefore, when we order kung ano yung pinaka-available, we are forced to choose that. Therefore, it might cause higher prices. So in other words, it's a way to tag performance, but it's also not a perfect performance measurement tool. Okay. Let's have another example, but this time direct labor. Okay. For direct labor, it's basically the same principles. However, the price variance for direct labor, we call it a rate variance. Okay. And then yung quantity variance for labor, we call it efficiency variance, labor efficiency variance. Okay. But it's the same principles. Okay. Iba lang ang tawag. Okay. Let's look at this example. So same company, the standard quantity is 1.2 hours per parka. And the standard price is of labor is $10 per hour. Okay, so that's the standard. For the month, for last month, no, the actual hours is 2,500, no, to make 2,000 parkas. Okay, and the total labor cost is 26,250. So our goal again is to compute for the three boxes. For box 1, how do we do it? No? Actual hours times actual rate. Actual hours is 25, galing yan sa given. How do you get the rate? That's 26,250 divided by 25 hours. So that's 1050 per hour. Multiply the two, 26,250 for the first box. Let's go to the third box. No? For the third box, we need to compute how much is the standard hours allowed for actual units. So the relationship is 1.2 hours per parka, right? And you produce 2,000 parkas. No? So therefore, with that, the standard hours allowed is 24 hours. No? Times standard price, which is $10. Okay. Then we compute box number 2, wherein we get actual hours versus standard rate. And we get 25,000 dito sa gitna. With that, we're able to compute our variances. So what's the rate variance? 25, 2650, 26,250 yung totoong ginastos. Okay? Pero dapat 25 lang kung standard rates. So therefore, it is 1,250 unfavorable for rate variance. Okay? For efficiency variance, dapat 24,000 lang yung ginastos. Pero, because of the difference in number of hours, gumastos siya ng 25,000. So therefore, it is 1,000 unfavorable. And the total labor spending variance is what? 1,250 unfavorable plus 1,000 unfavorable equals 2,250 unfavorable, which is the difference between what? 26,250 and 24,000. Okay, you spent more than what you intended to spend. Okay, so if you look at this, who's the responsible department? Usually it's production who's responsible here, because they can influence, they can decide the mix or of skill levels. Sila naman ang mga hiring managers naman ang nagde-define kung sino ang i-hire. No? So the skill levels, sa kanila yan. Motivation in the workshop, sa kanila yan. No? Or the work floor. Quality of the production supervision, sa kanila yan. No? So, but again, there also is issues because they can always blame others. Non-quantitative na yung reason. But of course, the numbers don't lie. So definitely, these variances are can be tagged to the production department. Sometimes for labor rate variance, HR is also tagged. Kasi usually may budget naman yan eh, in terms of total expenses. That's allowable based on the budget. But in reality, although HR has some influence on it, hiring decisions are by the manager. So therefore, tag din talaga si production manager kasi siya ang nag-decide na suwayin yung budget. Okay? For hiring. So those are some examples of potential issues with respect to responsibility. Okay? Next, let's have an example that's overhead. It's basically the same principles. Okay? For overhead, the standard hours is 1.2 still. No? However, the rate is $4 per hour. So standard quantity, 1.2 per parka. Standard price, $4 per hour. Okay. So same 25 hours, 2,000 parkas, spend 10.5. No? So again, 2.5, madali yan. It's the actual hours. How did we get 420? 420 is simply 10.5 divided by 2.5. So doon tayo naka-arrive at 420. And that's for box 1. For box 3, we need to get the standard hours allowed for actual output. No? It's 24 hours because it's still 2,000 barkas versus the standard quantity of 1.2 per parka. So we arrive at 2,400 hours, which is this one. Okay. And for itong gitna, it's actual hours versus standard price. Okay, and we arrive at the following variances. So this is a variable manufacturing rate variance and uh, variable manufacturing overhead efficiency variance. So if you see, the principles are the same. Okay. One important subtle point with respect to materials variances, no, actually, no, there's a difference between the quantities pag material variances. Okay. One subtle point is that for quantity variance, only the quantity used in production is used. Okay. Pag price variance naman, you use the entire quantity purchased. So the difference is the operative term. Purchased, pag price variance. Okay. Pag quantity variance, used in production. Okay. Note that this important subtlety only exists for materials variances. For labor and manufacturing overhead, wala. Okay. So, for example, okay, um, this is the standard rates, still the same. Okay. However, last month, 210 kilograms were purchased at a cost of 1029. Okay. Glacier used 200 kilograms to make 2,000 parkas. So the distinction lang is that used was 200, purchased was 210. So it just means na for the price variance, no, the quantity used is 210. So you use, sorry, for the price variance, no, 210 is the amount purchased. So you use 210 for it. Pero pagdating sa quantity variance, you use 200, which is the amount used. So if you look at this one, sa computation ng price variance, 210 is used as the base. Okay? With differences in standard pricing. So this is actual price, this is standard price. Pero yung quantity, na actual quantity, quantity here refers to quantity purchased. Okay? However, pagdating sa quantity variance, you use 200, hindi equal dito. Okay? Because pagdating sa quantity variance, we use the quantity used or consumed in the production process. Okay? So that's one important distinction. Okay, that's it. So hopefully this gives you an idea of variance analysis. This will supplement the text, and hopefully this is something that will be helpful for you in analyzing performance of a company versus their performance versus the budget. Good day.